So good morning, everybody. So let's start from exciting day, another second day today. So today we cover our first panel, this market conduct issue, and then we will followed by distinguished fellow panel and emerging market, and also our insurance market development in general. So this market conduct is very much heart of the IAIS. You know that IAIS mission statement states very clearly the purpose of our association, IAIS. The end of our mission statement make it extremely clear that why IAIS exists. IAIS exists for the interest and protection of policyholders. And market conduct is the heart of IAIS activities in that context. Of course, we discussed yesterday a lot on COMFRAME, particularly ICS and GSII and other topics. But market conduct has enormous work, and we have enormous achievement, not only ICPs, but recently we issued our application paper for market conduct issue, and we are ready to issue paper on our intermediaries application issues too. So we have considerable amount of work under this market conduct working group. And this group is chaired by Olivier Fliche. He's a director of our French authority, and he leads this group for market conduct. So this is an excellent opportunity for all of us to learn and to see how it evolves and how important this activity is. So Olivier, so I appreciate your leading for this panel. Thank you.
So thank you very much, Yoshi, for these words of introduction. And I'm very pleased to hear that market conduct supervision is at the heart of the mission of the IAIS. That's true. I mean, that's in the mission statement. The mission statement is to promote effective and globally consistent supervision in order to develop and maintain fair, safe, and stable insurance markets for the benefit and protection of policyholders. So protection of policyholders is here, and this requires both prudential and conduct supervision. So this is very important, and that's the first word of introduction I would like to say about market conduct. Historically, insurance supervisors have sought to protect policyholder interests mainly by focusing on the financial soundness, so on solvency, of individual insurers. Then, in more recent times, they extended the focus to the financial soundness of insurance groups and conglomerates. But with the financial crisis, I think we probably learned one thing, is that systemic risk can arise not only through failings in individual institutions and groups, but also in poor conduct of business practices. So that's why insurance supervisors and the IAIS have increasingly been turning their attention to conduct of business risk and supervision of this risk. So that's why it was timely that the IAIS last year published an issues paper on conduct of business risk and its management. Let me say a few words about this paper, and then introduce the panelists and the theme of the day. So as I said previously, the financial crisis showed that conduct of business risk can give rise to systemic risk. Well, we saw it, of course, with the indiscriminate selling of mortgage to people who could not afford them, So that's not exactly the insurance sector, but we saw it in the financial sector. And we saw also in the insurance sector that consumer conduct of business risk can generate consumer judgment, for example, when with widespread mis-selling of credit insurance in recent years. So that's why our group tried to look into conduct of business risk and its management, and first in the paper explain the different sources of conduct of business risk. The sources are multiple. We identify inherent factors, like, of course, the information asymmetry between the clients and the insurer, potential conflicts, consumer biases, but also sources in the governance and business process of the insurer, like poor product design, claims handling, the type of advice provided, the competence of the staff, and also external factors like economical and environmental factors. I think an important thing we discussed and we explain in the paper is that when we think about conduct of business risk, we have to think of the risk to the insurer and the intermediary, and also the risk to the customer. So that's one of the main difference with, I would say, prudential supervision of insurance risk. Then the paper tries to give the main issues for supervisors and also the main issues for the industry. Of course, for supervisors, and that's not new, that's also the case in prudential supervision, supervisors need to be aware of all relevant risk, conduct risk, and as I said before, and the sources are multiple, so we have to care about a multiple aspects of conduct risk. This means that we have to, as supervisor, we have to review and to analyze a number of different type of information at the level of the insurer, but also at the market-wide level. So that's also probably a specific aspect of COB risk supervision, is that we have to focus on individual supervision, as I would say prudential supervision, but we also have to care about the market outcomes and the data we can gather on the markets. And a third aspect is that we probably in conduct of business supervision, we probably have more to communicate to the markets. We probably have to communicate more our expectations to give to communicate on the standard we expect on business practices. For the industry, what are the key issues and the key challenges? I think the first one that the group identified, and so explained in the paper, is that insurers should really consider all aspects of COB risk in their risk management. So the risk management process is not only to mitigate, I would say, financial risk, but also conduct risk. And of course, this means that they also have to think about their governance processes to support the objective of fair customer outcomes. So that was a few words about the COB issues paper. I'm now come to the theme of the day, so there's no surprise in saying that the theme of this panel is conduct of business risk. And I shall be drawing on the experience and expertise of my fellow panelists to tell us about what some jurisdictions are doing to address conduct of business risk to consumers, to consider potential new and emerging risks, and also to give us their thoughts of what additional measures we could use to enhance consumer protection in this area. So I'm pleased to introduce now our panelists. So the first one to speak will be Patrick Déry, who is Superintendent Solvency at the AMF or IMF Québec since February 2013. Is responsible for the oversight and regulation of insurance companies, trust companies, saving companies in Quebec. And he also served as Superintendent Client Services, Compensation and Distribution. So I think he's got a wide range of experience, and this will be very interesting for us today. Another point to be aware of is that at the national level, Patrick is chair of the Canadian Council of Insurance Regulators and represent the AMF at the Credit Union Prudential Supervisors Association. And I think that in this capacity will give us insight of what is going on in Canada today. Then we will have a presentation by Michael Kofi Andoh, who is head of the Supervision Department of the National Insurance Commission in Ghana, the Insurance Regulatory Authority, where he has worked since 2000. So his responsibilities include licensing, as both as prudential and market conduct supervision. So today it will be about market conduct. And he's been involved in a number of projects to improve the insurance market access, to improve access to insurance in Ghana. And he's been actively involved in microinsurance regime. And he will speak today, he will focus today on mobile phone insurance. Then the floor will be William Vidonja, who is head of the Conduct of Business Department of Insurance Europe, the European Insurance Federation. So in this capacity, it contributes to the global and European debates on legal and consumer protection issues. So that's the point. And he is also part of the Employers Delegation of Insurance Sector's Social Dialogue Committee, which is a forum at European level where employer and employee representatives discuss topics of common interest. Our last speaker will be Birnbaum, who serves as an economic advisor and executive director for the Center for Economic Justice in Texas. So the Center for Economic Justice is a non-profit organization whose mission is to advocate on behalf of low-income consumers on issues of availability, of affordability, of basic goods and services, such as utilities, credit, and, of course, insurance. Birny is the author of numerous reports on consumer-related insurance subjects and has served for many years as a designated consumer representative at the National Association of Insurance Commissioners, and is a member of the U.S. Federal Advisory Committee on Insurance. So he will provide us the consumer perspective in this panel. So it's now time for me to let the floor to Patrick for the first presentation. Thank you.
Merci, Olivier. Good morning, bonjour. I noticed somewhat fewer colleagues this morning than yesterday for the capital session. I would suppose that's because there's a large consensus on market conduct issues, something we don't have yet on capital. Or maybe that's because our colleagues, some of them enjoyed too much of Tokai wine last night. I'll assume it's the first explanation. My name is Patrick Déry. Maybe my baby face is not that familiar to you. Maybe you know more my colleague Julien Reid, who served as chair of the Market Conduct Subcommittee before Olivier. My colleague Julien is responsible for part of the work that have led to ICPs 18 and 19 in the past few years. So I guess you're asking yourselves, those Canadian buggers who, developed all that stuff that is now imposed over the world, how do they fare in Canada about ICPs 18, 19? So that's why I'm here this morning. I'm here to report about that a bit. I hope I'll convince you that we have somewhat an interesting story to tell. A bit of background before I start, so you understand the challenge we face. Canada is a federation. There's a federal government and there's 13 provinces and territories. So about 14 governments for a population of 36 million people. As the Constitution states, there are some areas of authority that belong to the federal government, others to the provinces and territories, and for insurance business, it's mixed. So it's a bit complicated. By the way, since I've been, coming to those international meetings, when I hear at home that our regulation is complex, we have 14 regulators, I now tell them, well, you should try Europe, you should try Asia, that's complex too. So if there's one takeaway you can use back home, and you have an industry saying your national regulation is complex, you can say, well, try Canada, that's complex too. So we have to find ways to balance things and agree and discuss those issues among ourselves. And to do that, we have, for the provincial level of the regulators in insurance, we have a forum called CCIR that I chair since last year. And this forum is not a standard-setting body, but we as provincial regulators get to those tables and agree on priorities and solutions, and we go back in each of our province to implement those things. So that's basically the context in which we have to find solutions to implement ICPs 18 and 19. The sub-bullets in the middle of the slide there, I forgot to mention it, but in Canada, the market conduct supervision is a responsibility of provinces and territories only. So it's among the 13 provinces and territories that we have to find ways to implement that framework. A few words on CCIR, Canadian Council of Insurance Regulators. As I said, it's comprised of the 13 provincial and territorial regulators. It facilitates and promotes an efficient and effective insurance regulatory system in Canada. And as I said, it develops solutions to common regulatory issues, but each province is responsible to implement them. How did we made it last time IMF came to Canada and under the FSAP program? In 2013, basically the report was quite good. As Yoshi would say, the glass was more than half full. The framework per se was assessed as in alignment with the ICPs, but there are some issues in terms of the capacity in the system to be proactive and to implement it on the ground. Only Ontario and Quebec were assessed by the IMF. 3 Canadians out of 5 live in either Quebec and Ontario, so it's a significant share of the market. But the findings of the IMF were about how can you convince the assessor that as a whole, the provinces are capable of not only having the words on the paper, but also have the teams and the programs in place to be efficient and proactive in supervision of market conduct. We decided that we wanted as a group to be doing better next time the IMF comes. It should be in 2017 or 2018 at the latest. So we have those goals, I have put on the slide, increase observance with the ICPs, improve the coordination among us in order to do the supervision of market conduct and improve the protection of the public, increase the information sharing and the cooperation among ourselves, and be very more proactive in terms of the risk to the consumer protection. And how do we do that? We agreed together to work on what we call the market conduct, cooperative market conduct supervision framework, which will allow us to work on the ground, to conduct a cooperative market analysis, to develop cooperative supervisory plans, to conduct cooperative insurer-specific reviews, and to conduct cooperative thematic reviews. Again, in Canada, for an insurance company to sell insurance products, it needs a license from each province in which it wants to do business. So one possible issue is for one insurance company having to face, as I said, 13 regulators who could come up anytime in the year asking questions about market conduct issue. So we try to avoid looking like a cat herding stuff, with a group of small cats going everywhere, but going into that supervision with a united and coordinated approach, so that from the insurer's point of view, it feels like working with one group of regulators instead of 13 separated regulators. Also, it includes sharing and leveraging the resources we have in supervisory activities across provincial and territorial borders. So again, one of the things we want to achieve here is to be fully compliant with the ICPs, doing what's right for the consumer, but without adding to the burden in terms of increasing the resources needed to implement that framework. So basically, there are four components to the framework. The first one, the foundation, is an MOU, a Memorandum of Understanding, that allows a regulator to share information and to protect the information that is shared. This is crucial for the insurers who will have to open their books and open their kimono, as we say sometimes, to allow us to look at what they're doing and understand their market conduct practices, etc. So for them to have trust into this process, this cooperative process, there has to be an agreement, formal agreement, protecting the information that is shared. Over the last year, 10 out of 13 members have signed the MOU, so it's more than 95% of the market in Canada. And we expect the three remaining provinces and territories to join soon. It's just a matter of timing for getting the signature of their government. So the MOU is the first step, or the first item. The second is the cooperative framework per se. So we had to agree on what we would do together, what we would share. So you have this on the slide there. It was released, it's public, it's on the CCIR website. So we decided that we would specifically target cooperative reviews on, as I said, thematic and insurer-specific reviews, systemic market analysis, consumer complaint statistics, and reviews of a new product and product changes. So the framework was essential in order, before we start going on the ground, start by agreeing on what we would try to do together in more details. The third item is to help doing off-site analysis, is to develop what we call an annual statement on market conduct. So it's like for solvency purposes, it's an annual statement that each company will have to fill and send to us as a group. Again, instead of having to file 13 maybe different requirements from each regulators, we have one harmonized annual statement on market conduct. So it will help feed a data system and some BI that will have to be developed to make sure that we can be more proactive and see trends, see emerging issues better than we can do now. And the fourth and last, whoops, I think let's skip the slide now. No, okay. And then, okay, I'll put it in the next steps, but the fourth element is the on-site inspection program per se. And we are in the process of making that decision, and the next meeting we'll have in a few weeks. This is on-the-ground sharing of resources, agreeing on which in-server or which theme we want to focus on in the first year of this new approach. So we will try to under-promise and over-deliver. It's important for us, but again, the idea here is without adding burden, without adding resources in the system, but leveraging the resources we already had. How do we organize ourselves as a group of 13 regulators so that we can cover what we expect or assume to be the most important risks in terms of market conduct in Canada? So those are basically the four items of the framework we are putting in place. The annual statement, we targeted to be ready for the industry to fill for the first time, first quarter of 2017. And we are in the midst, as I said, of implementing our first on-site market conduct program in this current fiscal year. So this concludes my presentation. I thank you for your attention.
Thank you very much, Patrick. So I suggest we go on with Michael's presentation.
Okay. Good morning. Ghana has been implementing a financial inclusive project or strategy to improve access to insurance for the low income and the informal sector. This involves or has several aspects, but one thing we have been doing is to take stock at some point in time to find out where we are, the challenges that we are facing, and what we need to do to go forward to make progress. One of such stock taking in 2011 told us that the microfinance institutions were the biggest channel of distributing inclusive insurance products in Ghana. We were quite familiar with microfinance institutions and how they operate and exactly how the products are sold through the MFIs. So we virtually had no major problems there. In 2014, we conducted another study and realized that now the mobile phone is the biggest distribution channel for inclusive insurance products. Now we had an issue because we were not very familiar with how all this works. We knew for sure, one thing we knew for sure was that there were some risks that we were running, even though we accept that this is a very good channel because over 90% of Ghanaians have mobile phones. And if we could sell insurance through the mobile phone, that means a very good potential access to insurance. But there were risks, conduct of business risks that we knew existed, and so we had to find ways of identifying these risks and to decide how we are going to manage them. And so we conducted a study into these risks to enable us see what we have on our hand and how to go around it. And in a few slides, I'll share with you what our findings were and what exactly we are trying to do to deal with the problem. Okay, so this is how the mobile phone landscape looks like in Ghana. As at June 2015, about 2.7 million mobile phone policyholders. This is about 60% of all inclusive insurance policyholders in Ghana. There are usually more than one or two parties involved in a mobile insurance product package. You would find mobile phone or mobile network organizations, what we call the MNOs. These are the telecommunication companies. And then there are the insurance companies. And then there are technical service providers. Sometimes you find a fourth party because sometimes the technical service provider is split. You have one that provides information technology service and then one that provides the insurance management service. But in most cases, you have three parties. Currently, we have about 6 products that are sold on the mobile phone in Ghana. So what do the parties do in a collaboration? When you find a normal mobile phone insurance product or collaboration, you find the mobile network organization and they brand the product in their name. So if you find an MTN or Tigo or Vodafone, they will brand the product in their name, and a research by one of our marketing organizations showed that people trusted the MNO brands more than the insurance brands. And so the MNO will usually brand the product in their name to enhance the marketability of the product. The insurers, of course, carry the risk, and they do the pricing and the reserving. They carry the risk, the costs, they bear the cost of the claims, and that's about all they do in most cases. The rest of the operations is usually done by the technical service provider who manages the data, they register the client, they receive complaints, they administer claims, and all sorts of things, other things. So basically within the collaboration, these are what you would find. Now, what risks exactly did we come up with? What risk did we find out we were running with the mobile phone insurance? We tried to categorize them, have about 7 categories of them. Briefly, I'll go over them, and then I'll tell you what we are doing to handle them. Now, the first one is the client value risk. And the client value risk is the risk that the customer, the consumer, may not find enough value in the product, either because, one, they don't entirely understand the product, the terms and conditions and other things surrounding the product, they don't clearly understand, or because the product is not suitable for them. The risk which the product covers is not one that occurs quite frequently in their daily lives or in their economic endeavors. And so in that case, you will find the claim incidence very, very low. This is where the product may not be suitable for them, or sometimes the product may be suitable for them, but let's say, for example, the sum insured, and in most inclusive insurance products, the sum insured are the same. They are standardized product. So you'd find a sum insured of, say, $200 for a whole batch of consumers. And there's a possibility that the sum insured may not be adequate to cover the risk of a loss or the cost of a loss that is suffered by the consumer. Let's say if we have a hospital cash product that offers $50 for somebody who is admitted in hospital for a minimum of 3 days, This person may actually spend about $100 or $200 in the hospital, but the product covers or offers $50. So in this case, you find out that even though there is some value, the product is relevant, the sum insured is not enough to fully cover the costs of the loss that the consumer suffers. So that's the client value risk, or what we call the client value risk. Then we have the distribution channel risk. I already talked about the parties involved in the mobile phone insurance package. And the distribution channel risk is a big one, and it is the risk that the distribution channel, which in most cases will be the telecommunication company, which is involved in the package, may either make some sudden changes to existing product or even discontinue with the product altogether. This is probably because the MNO changes strategy at some point, or they don't see the business value. You know, usually when MNOs get into these collaborations, it is usually, even though they like making money on it, one of their big objectives is to increase their average revenue per user and to reduce what they call churn, that is switch between the lines. So there are about 3-4 mobile communication networks, and they want their consumers to be loyal to them, to keep using their lines. And so they think that by offering some of these added values, the consumers would not like to switch between the lines. And so when they realize that these, they are not achieving these, they may not see the commercial value there in the product. And then they may want to make changes or discontinue with the product, which may have very serious consequences. So that's the distribution channel risk. Now we have the marketing and sales risk, which is just the risk that the product may be missold. The information that is given out to the consumers may not be enough, may not explain the product enough, or may lead to some false expectations by the consumers. And so by the time they buy the product or when they think they are due for claim, they may find out that they are not. That is just because the product was missold to them. And then we have the legal risk. This is the risk of some legal uncertainties or problems to do with the product. For example, the complaint dispute resolution mechanism. Now, when there are 3 parties in the package, it is usually difficult for the consumer to know how to get his issues addressed. Some of them have tried to go to the MNO's sales offices, who obviously don't have the capacity to deal with their issues. And then there's the issue of the product ownership and accountability. You know, because the products are branded by the MNO, by the telecommunication company, sometimes the consumers get confused. They think they are buying insurance from the MNO. In actual fact, they are buying insurance from an insurance company, but because of the way the branding and the marketing is done, they often think that they are buying insurance from the MNO. And so, and then there are data protection issues, and there are policy documentation issues, because as much as possible, these are very low value policies, about $50, half a dollar, okay, half a dollar per month. And so you have to be extremely careful about physical documentation and things like that. But of course, if you don't have those documentations or a summary of a contract or something, and then there is a dispute, it becomes difficult, because you usually need some terms of reference at some point to be able to resolve a complaint. The next risk that we found out was systems risk. systems risk, and that is where the service providers database or ICT platform may not be operating effectively to service the product. In fact, in Ghana, sometimes these systems have a downtime. So whilst the system is down, a lot of things can go wrong. Usually what happens is that the system generates reminders and sends messages to the consumers. They pay every month, and when they don't pay up every month, there are consequences. And when the system is down, the system is unable to send a message to a consumer whose contract is due for renewal to say pay up or do something. And so you may find some problems when these systems are down, or when or data issues when the system collapses altogether. Then we have the third-party default risk, and as we saw, there are 3 parties involved, and if any of them default or does not play its expected roles, there will be consequences and one prominent one is the technical service provider, because they play a very crucial role. So if they are inefficient at doing what they are supposed to be doing, or they don't have the capacity, the resources and the equipment to do it, or say they decide to quit the partnership, that creates a whole lot of problems, because they will disrupt the entire program. Finally, we have something that starts as market conduct risk but ends up at a prudential risk. And this is the risk that the product may not be commercially sustainable, commercially viable, because of some market conduct issues, like say very high rate of fraud or anti-selection, or say underpricing, which usually happens because these products have to be as cheap as possible. And sometimes or often, you don't have accurate data as you would have for the conventional market to price these products. So they have to use a lot of assumptions and guesses to do the pricing. So at the end of the day, if the product is underpriced, then there will be some issues with. So how exactly are we trying to mitigate these risks? And now, the study was just completed last year. We are still in the process of implementing the recommendations. Some of them are easy to handle, which we have done something about. Others need some time to figure out. The first one, we are using our product approval measures. Already our Insurance Act requires insurance products to be approved by the regulatory authority. So at that point, we see to it that the wording, the arrangements, the sum insured, these are fair to the consumer as much as possible to make the product viable. And we see to all other arrangements. For example, we would, if it's going to be a collaboration like this, we would demand what they call the living will, that if the parties decide to discontinue the product, there must be some processes that they have to go through now. How long notice do they have to give each other? How are they going to handle the data? How are they going to inform the customers and possibly switch them on to another consumer and things like that? And then product performance monitoring. While the product is launched and still being sold, we gather data and we monitor some key performance indicators. And if some indicators go out of range, then it will trigger an investigation to find out what it is. One of the products, I think was a hospital cash product, had a very low claim incidence, and so we tried to find out exactly what was happening, and we realized that it was just a little bureaucracy. The document to be you could just take a photograph of something from the hospital that shows that you were admitted in a hospital and was up to the insurance company. And apparently the hospitals knew that the claimant were going to use this to collect insurance money. And so they wanted the consumers to pay some money before they give them this document. And so that was easy to handle. So once we monitor these KPIs, we are able to drill down and find out what's going on. Currently, we are working on mobile insurance regulations in Ghana. This is still work in progress. We are still discussing the concepts and the principles. There are a number of issues coming up. And then, because there are a number of parties in the chain, we are adopting cooperative supervision. So currently we are trying to get sign an MOU with the National Communications Authority that regulates the telecommunication companies and the Bank of Ghana that regulates the financial services, because some of the product use mobile money to pay for the product, so we can have a comprehensive supervisory approach. I think I'll stop here, and thank you.
Thank you very much. So now, William, the floor is yours. Since I would like to have some time for question, I ask you to stick to 10 minutes, and then we will have 10 minutes of presentation and some question. Thank you.
All right, thank you very much, Olivier. Good morning, everyone. For the non-Slovenians people in the room, and there might be a few, my name is William Vidonja. I'm a French national, so I'm going to make use of my 10 minutes to the full extent, but in a French way. French 10 minutes might not mean 10 minutes in the rest of the world, but we'll find out very quickly. I'm going to address 3 different issues with my presentation. The first one is a very short update on the EU developments when it comes to conduct of business framework. The second one is going to be a couple of provocative thoughts on whether the regulatory and supervisory framework for conduct of business can be a source of conduct of business risk. And the third one is going to be on how to address that and avoid that the regulatory supervisory framework is leading to conduct of business risk. So how to ensure the best outcome for consumers. But before doing that, so which one do I need to press? That one. Before doing that, I'd like to start with two comments, 2 observations. The first one is a very, very simple and straightforward message. I think insurers have consumers at heart. What I'm seeing here is a vast majority of insurers are really striving to satisfy their consumers. On a constant basis, they develop new products, new services to try and meet the evolving needs and demands of consumers. And why are they doing so? Well, I believe because they have a keen and genuine financial and commercial interest to do so. A satisfied consumer is more likely to be a loyal consumer, and of course this has a positive impact on the reputation of the insurance company itself, but also on its business. I'm not saying that there's no role for the regulatory and supervisory framework, because of course there is one. The regulatory and supervisory framework on conduct of business is, of course, useful to monitor and mitigate conduct of business risk. My second observation is about the IAIS issues paper on conduct of business risks. That's probably not really obvious from the picture on the screen. But what I'm trying to say here is that diversity is really important. And diversity is one of the key element which is stressed in the IAIS paper on conduct of business risk, where it is really acknowledged very clearly that conduct of business risk and its management needs to consider the local market specificities and the local consumers. And here I see a comparison between chocolates. I live in Belgium and I love chocolates, and between insurance and conduct of business. You got dark, milk, white, cream, with fruits, with alcohol, and I'm not speaking about insurance here, I'm speaking about chocolates, obviously. But what I'm trying to explain here is diversity, and the same goes for insurance and conduct of business across markets and across the world. The legal, social, tax frameworks, the distribution structure, the consumer needs, demands, expectations, their cultures, their traditions, their level of financial education and literacy, they do vary very much across the world. And the same goes within Europe. I'm still looking for the European prototype of a European consumer and can't find it because it does not exist. Consumers are all different. And again, I'm not questioning the fact that we need to have high-level principles on conduct of business at supranational level. This is useful. But what I'm saying here is that very often the local regulators and supervisors are also better placed to make sure that the conduct of business rules are effectively matching the local market specificities and the local consumer needs. So getting back to the core of the issue for this morning, I'm pleased to inform you that we now have an extremely comprehensive, impressive even, conduct of business, regulatory and supervisory framework in the EU now. This is brand new. It has been agreed. It's not yet in force, but it's going to be very soon. And it's composed of different layers. The first one is the legislation at European level. You obviously all heard about Solvency II framework directive. It also includes provisions on product disclosures for life and non-life insurance, and even a cancellation right for life insurance. Then we got the brand new PRIPS regulation, which is imposing the provision of a short standalone document called the Key Information Document to retail investors, consumers, before they buy an insurance-based investment product or retail investment product. This document should be 3-page long and answering to the key question that consumers have about this type of products, the risks, the costs, and the performance. So it's a regulation that is aiming at allowing consumers to compare the different offers on the market and take informed decision. And then we got the EU masterpiece on conduct of business, the Insurance Distribution Directive, IDD. And this directive is, of course, regulating the way insurance products are being sold, distributed by all types of distributors across the EU. So you have rules on sales disclosures, you have rules on advice, on remuneration, conflicts of interest, cross-selling, but this regulation, this directive is also including rules on product oversight and governance, and rules also on product disclosures for non-life insurance. You know how the EU is complex. We have then a level 2, which is coming as a complement to the level 1 legislation. The European Commission and the European supervisory authorities, including EIOPA, are now working on level 2 for the presentation and the contents of the KID, so fine-tuning the details of that. And of course, you know, European colleagues, that the devil can be in the details. EIOPA is also working now on implementing measures for product oversight and governance, conflicts of interest, inducement, suitability and appropriateness tests. And on top of that, they have the possibility to issue guidelines on cross-selling or on the understanding of risks for insurance-based investment products. And we might expect also the European supervisory authorities to work on level 3 measures in relation to the key information document for PRIPS. We say in French, jamais 2 sans 3, so it means never 2 without 3. Here it's never 3 without 4. There's also level 4, which is actually the transposition of the directives by member states. So to become applicable, you need to have transposition by member states in their national law for directives. So the Insurance Distribution Directive and Solvency II needs to go through national law, and that's a possibility for member states to adapt the different rules in these directives to the local market realities. It's also sometimes a good way for these markets to gold plate the existing framework at European level. I'm sure you all know also that our European Supervisory Authority has consumer at the core of their top priorities. Just as a matter of example, they issued earlier this year strategy on risk-based and preventive framework for conduct of business supervision, taking to a wide extent inspiration from the IAIS issues paper on conduct of business risk. If you had the chance to read the two of them, you will find a lot of similarities, with EIOPA, however, going a bit further on a number of instances. And the same goes also on the side of the industry. Of course, we have in the industry a strong focus on consumers. We, in Insurance Europe, have developed an interactive tool which is providing a sample of some of the existing insurance industry-led initiative meant at further protecting consumers in the EU. So this is addressing digitalization, innovation, claims management, conduct of business issues, transparency, and financial education. Coming now to my second question, to spice up a bit the discussion, I'd like to ask whether the regulatory and supervisory framework on conduct of business can be a source of conduct of business risk. And I do believe so. I do believe so. If you look at the IAIS paper on issues on conduct of business risk, there is a sentence which says quantity over quality approach should be avoided. And we're speaking about disclosure, and of course I very much agree with that. It is very important that regulation is focusing on the quality of disclosure and avoid overloading consumers with information. Overload of information means consumers are confused. In the case, they read the information. So let's go through a practical example. An insurance-based investment product sold online by a broker. Until very recently, at EU level, the consumer had to receive 75 different pieces of disclosure at pre-contractual stage. 75. This is huge. I mean, if you look at any behavioral economic studies, they will say it's already too much. With the new regulatory framework at European level, this number is going to simply double. 148 disclosure requirements. Sales disclosures, they're not going to double, they're not going to triple, they're going to quadruple. Is this going to help consumers to take informed decision? I'll let you thinking about that. My second example relates to overlaps or even duplications between the different pieces of new legislation at European level. Typical examples, Solvency II directive and PRIPS regulation, they both provide for similar types of disclosures, but the PRIPS regulation is imposing a very formal type of format for disclosure, which means in practice that consumers are going to receive twice the same type of information, but in a different wording, in a different format. For me, it's difficult to imagine a situation which is more confusing for consumers. I'd like to add that this is a tip of the iceberg, because this is a result of the level 1 legislation. This may actually get worse with level 2, level 3, and maybe with member states also transposition. Again, I don't think this helps consumers in any way. This is actually moving them away from the opportunity to take an informed decision. To conclude now, so yes, at EU level now we've got a very strong, comprehensive, very solid and very impressive regulatory and supervisory framework on conduct of business. The problem we have is that every single piece of the new legislative framework has been developed individually, in silo, without paying any attention to the effect that these different pieces of legislation would have together on the consumers. So no cumulative impact assessment. I think this is a huge mistake, because this is a source of conduct of business risk. This is a huge mistake that can still be addressed, but there are also good lessons for us to learn from this situation. And the lesson for me is that it's not only the industry that should take a consumer-centric approach, it's also the regulators and the supervisors. And that means in practice that I strongly think that any proposals related to the regulatory and supervisory framework should go through a very, very serious and solid impact assessment, making sure that any proposal is providing ultimately consumers with a net benefit. The individual proposal on its own, but also all the different proposals all together, cumulatively, should provide consumers with a net benefit. Something else which is really important is a consumer testing. This is, I think, a basic when it comes to disclosure requirements, pre-contractual information. They need to go through a reality check. Very often, we realize that regulators and supervisors have ideas, very nice on papers, but would do not survive or go through the reality check because consumers have very different perspective and understanding of the supervisors and regulators very often. We think that these types of processes or approaches would help having proposals meeting their intended objectives and ultimately benefiting consumers. This is a proposal that we think could be applied to, of course, European legislation at level 1, 2, and 3, to member states' legislations. But I also think that when at international level there is a review or development of new principle that relates to conduct of business rules, they should go also through this kind of processes and be checked against reality. Thank you very much for your attention.
Thank you. Thank you very much, William, for your slightly provocative presentation of EU rules. Must confess, I appreciated your illustration of our issues paper with chocolates. Probably I will go back to the market conduct working group suggesting we adopt this type of illustration for our next papers. So now I'm pleased to give the floor to Birny for the last presentation.
Thank you. Okay, how do you move the slides? Fantastic, thank you. Good morning. So first I want to thank the IAIS for inviting me to participate in the global seminar. And I want to thank the NAIC for the financial assistance to travel here. Without that assistance, I would not have been able to participate, so thank you. And I also want to thank Olivier and the members of the Market Conduct Subcommittee for your important work and valuable work. So I'm going to start by challenging the IAIS and insurance supervisors across the world to rethink the importance of conduct of business oversight. At the IAIS, as well as the NAIC, and in almost every jurisdiction, the resources devoted to prudential oversight dwarf those available for conduct of business oversight. Would a 9-to-1 ratio at the IAIS be an accurate assessment, I wonder? The fact that the disparity in resources for prudential and conduct of business oversight is often justified by the claim that supervisors' principal job is consumer protection, and no consumer protection is more important than the oversight of insurers' ability to fulfill their promises to policyholders by paying claims and benefits. Well, we certainly agree this is a vitally important outcome and role for supervisors. But have supervisors done a cost-benefit analysis of the resources devoted to prudential versus conduct of business oversight? How many more insurers would fail if you shifted half of your resources from prudential to conduct of business oversight? But how many more consumers would be protected against abusive products, sales, and claim settlements if more resources were devoted to conduct of business oversight? I suggest the benefits of greater conduct of business oversight would be very large. Consider the avoidable abuses of credit insurance and payment protection insurance, or so-called retirement income products sold by conflicted advisors. In addition, additional supervisory resources to collect data and monitor market outcomes for consumers would actually improve your prudential oversight efforts. Here's why. There are very few insurer insolvencies. That means that it's difficult to analyze the effectiveness of the many prudential oversight policies and practices in an empirical fashion. Almost all of the oversight techniques, from increased capital to corporate governance review to risk assessment review, to name just a few, are based on the belief that there are supervisory practices, these are supervisory practices that will help avoid insurer solvency failures. But these policies and procedures cannot be empirically tested because there are so few historical negative outcomes. You'll just have to wait until the next crisis to see if these prudential tools worked. On the other hand, regulators and supervisors can empirically evaluate the effectiveness of insurer conduct of business practices. Supervisors have the ability to collect data on consumer market outcomes to objectively measure how well insurers are treating consumers, with metrics like the consistency of claim payments for similar claims, times to process and make a claim payment, frequency of claim denials, frequency of consumer complaints, types of consumer complaints, frequency of sales denied, reasons for sales denied, consistency of pricing across similar risks, frequency of unsuitable sales, and the list goes on. If an insurer consistently produces good consumer outcomes, it stands to reason that the insurer has a good corporate culture and solid policies and procedures, the types of corporate cultures and practices consistent with strong risk and financial management. On the other hand, if an insurer routinely produces poor market outcomes for consumers, a supervisor should have great concerns that whatever procedures are in place for risk management and financial management are also not working. The idea that good consumer outcomes is consistent with sound risk and financial management, or more importantly, that bad consumer outcomes are associated with poor risk and financial management and management fraud, were graphically demonstrated with the sale of abusive and predatory mortgage products in the run-up to the financial crisis. There are at least two other benefits to monitoring consumer outcomes in insurance markets. First, supervisors will obtain more timely information on market trends, putting yourselves in a position to more proactively address market problems. This capability is particularly important as insurers employ more big data applications. Second, the vast majority of insurers will benefit from less intrusive regulatory oversight. By monitoring market outcomes for consumers, supervisors can focus attention on companies with problems and forego unnecessary involvement on things like corporate governance of insurers who produce good market outcomes for consumers. So CEJ and other consumer organizations challenge you to place more resources and effort into conduct of business oversight. The remainder of my comments will focus on ways to monitor conduct of business in insurance markets. So, as a preliminary step, it's vitally important for supervisors to establish clear expectations with their licensees, with insurers and intermediaries, about what's expected of the treatment of consumers and what are the expected marketplace outcomes. There are many ways to convey these expectations, from things like a consumer bill of rights to any number of other approaches, but it's important, vitally important, to set the framework for insurers and intermediaries to understand what's expected of them and what consumers should expect from insurers and intermediaries. So how do you go about monitoring insurance markets? Well, how do you do proactive supervision? Well, I would say that one of the first things is product and form approvals for individual and small business products. The notion that consumers will understand complex legal documents, that they will somehow be able to foresee in the future how these products will play out, in the absence of any information about how well insurers actually perform on those promises, makes it extremely difficult, if not impossible, for meaningfully competitive markets to operate. I can't stress enough the importance of testing consumer information, education, and disclosures. As Williams pointed out, the default response to any number of regulatory problems is, we'll do a consumer disclosure. Consumer disclosures do not necessarily empower consumers. Insights from behavioral economics give us a great deal of information to understand when disclosure will be effective, and in those circumstances, how to craft a disclosure. Too much information does not empower a consumer. Probably the most important thing I would ask you to take away is the collection and analysis of granular data on market outcomes, what I'll call regulatory big data. This is the fundamental building block for your market analysis and evaluating the outcomes for consumers. There are other tools that you can use: solicitation and collection of consumer complaints, as well as praises. It's important to do economic analysis, so you identify those markets in which the interests of the intermediaries and the insurers do not align with the interests of consumers. You don't need to be a rocket scientist to understand that the market structure for credit insurance and payment protection insurance, the reverse competitive markets, are going to lead to adverse consumer outcomes. You can do a lot with consumer surveys. You can do a lot with mystery shopping, where you actually go in and shop as if you were a consumer. And one of the benefits of collecting granular data on market outcomes is that you can publish that information. You can empower consumers with information on which insurers have really done well in the market, so that consumers can shop around for more than just the basis of price. So I want to finish by emphasizing the critical role of involving consumers in the regulatory process. It's vitally important to figure out a way to formally involve consumers so that you get consumer feedback. As you see in this room, there's any number of insurer interests and intermediary interests who are willing to share their views with you. Consumers often have a different take. It's important to get a balance. There are lots of ways to do that. There can be a formal consumer agency. There can be funding for consumer advocacy. You can establish consumer advisory councils. I and other consumer organizations stand willing to help you figure out the best way to do this. But one of the things that the IAIS could do is have a track in which it assists jurisdictions in best practices for involving consumers in the regulatory process. So thank you. I look forward to your questions.
Thank you very much. We've got now 10 minutes before the end of this panel. I would like to know whether there are questions in the room about the presentation. Yes.
I have a question for Ghana. In terms of your mobile, penetration, was it something that was initiated by the mobile network operators and not something that the supervisors facilitated the framework? And the second question is, if you were to do things differently, what would you do in terms of your supervision of the mobile operators and the distribution network that they currently have?
I didn't get your second question right. Can you let me?
Oh, okay. My second question is, looking at the state of your industry in terms of mobile penetration, what would you do differently if you had to, do this all over again?
Interesting. The first question, an insurance company and a telecommunication company approached the NIC and submitted a product for approval. Of course, the law requires product to be approved, and so they submitted a product for approval, and for the sales administration, we realized that they wanted to partner this the telecommunication company to sell it. And it was an innovation at the time, looking at what the assessment they had done and the proposals they had put out. We thought that was going to help to reach out to a lot of people, and so we looked out for the risks, and we tried to get them to manage them and approve them to go ahead. So yes, we were approached and with an application, and we went ahead and did the approval. So that's how come we got there. And of course, as it got successful from year 1, year 2, other collaborations also came up, and now we have about 3 collaborations with telecommunication companies in there. What we will do differently? It's a difficult one, but I believe that the collaboration with other regulators, because a very big difficulty in there is, there are other non-insurance entities involved, the MNO and the technical service providers, and so having a good collaboration with the regulators of these to improve the coordination and the supervision will be very good to handle. The other issue is about the mobile money itself. Currently there are 2 ways of paying the premiums by the consumers. They could use their airtime to pay the premiums, and they could use mobile money to pay their premiums. Now, there seem to be issues with using the premiums to pay the money, because the central bank says that the airtime is a commodity, and therefore the central bank is not comfortable with using people using their airtime to pay for services. Going back, if we had the opportunity, what we would do would be to develop the mobile money market, get people, a lot more people to use mobile money. Currently, East Africa has developed this much more. A lot more people use the mobile money, mobile wallet, and so it makes it easier and more secure for them than in West Africa. But that's something we are working on, and I really wish that we had developed that earlier.
Yes, a question here.
I'll get up and walk to the microphone. So, Birny, it's a fair challenge you put out to us there about involving consumers in the regulatory process. Is there any other international body who does it well? And if there's no international body, are there any domestic bodies that do it well? Wasn't the microphone working?
Sorry, who?
So my question was, you challenged challenged us to involve consumers in regulatory development. Is there an international standard-setting body that does it well? And if not, are there domestic standard-setting bodies that do it well? So who can we copy?
I caught the first of it, but I still didn't understand the question. One more time?
My voice is gone this week anyway.
Come,
Is this working?
come closer.
So, is that better? Okay. All right, so you challenged us to involve consumers in our work. Is there actually an international body that does that well? And if there are no international bodies, are there domestic bodies that do that well? Because it would be much easier for us to use a model that somebody else has developed rather than build our own.
Okay. Excellent question. So the question is there an international body of consumer organizations that work on insurance issues? Or are there national bodies of consumer organizations that work on consumer issues? And I would say the answer to that is generally no. In some of the sort of more developed economies, there are consumer organizations and consumer federations that work on insurance among other issues. But the issues that they tend to work on are often very limited. For example, in the US, most of the consumer organizations work on health insurance. There are very few that work on life insurance issues. So one of the challenges I think, to regulators is to develop the consumer expertise and interest in participating in the insurance regulatory process. So what might that look like? Well, here at the IAIS, that might be affirmatively reaching out to consumer organizations who don't currently work on insurance issues, to encourage them to work on certain insurance issues that might be related or relevant to their work. But the challenge that we've posed is, in fact, very challenging. That it means that you will have to do things in an affirmative fashion that's different than what you're doing now. Consumers will not just show up to your events the way your industry stakeholders do.
I think, William, you wanted to add something?
No, actually, I wanted to raise a question also to Birny.
Okay.
Sorry for that.
Please.
I'd just like to refer to one of the slides, one of the final slides you had on supervision of conduct of business. In that one, you spoke about proactive supervision and you referred to consumer testing, disclosures, and education. What is for you the role of education in mitigating conduct of business risks?
Well, so just to make sure everybody understood the question, what's the role of education in mitigating conduct of business risk? So consumer education, we group consumer information, education, and disclosure together because they blur into one another in terms of what's given to consumers. And it's important in a number of ways. The first is to ensure that consumers understand the promise that they're getting. They understand the product, that their expectations are set in an appropriate manner. The second is that they understand their responsibilities. A third reason for that is so that consumers get engaged in loss mitigation and risk prevention. These are all sort of important aspects of that. But I do want to make clear that when we talk about consumer testing, we're talking about supervisors using the insights of behavioral economics and actually testing with consumers disclosures and information. It's absolutely important to make sure that the information you're presenting as a disclosure that you believe will empower a consumer, in fact, accomplishes that. Too many pieces of information or documents that are presented as a disclosure do nothing to empower a consumer, but in fact confuse the consumer. So we have now 10 years of insight from behavioral economics that really can help us better craft consumer information, education, and disclosure in a way that actually empowers consumers and makes markets more competitive.
I think there is a last question in the room.
Yeah, thank you all very much. My question is for Mr. Andoh. In regulating the mobile networks, mobile insurance networks, is there an issue of like cybersecurity or people trying to hack into networks and steal data on consumers? And if so, what's your approach to that as an insurance regulator?
That's an issue that the MNOs and the other stakeholders have started talking about now. Related to that is issue of data protection and privacy of the data of the MNOs subscribers. I must say that as at now we do not have very clear regulations on that yet. We don't have any incidents of hacking yet, but these are risks. These, I think, will fall under the system's risks, and so we've started talking about that. I believe we will address that in the mobile insurance regulations, but at this stage, we don't know exactly what we are going to say.
Thank you very much.
Thank you very much. I see we're running short of time. I'm very sorry because I think we had lots of other questions probably to tackle. We addressed many issues, many ideas. I see that the point of mobile phones and new technology is of interest in the room and also here. So now I suggest I apply fair treatment of panelists principle, and so give them an opportunity to give us, I would say in a few sentences, the last key message they want to pass, or I would say the main challenge they see for the next years for conduct of business risk. So I start with Patrick.
Merci Olivier. First, I want to apologize for having told you that Canada is complex. I guess William showed that no, Canada is simple and Europe is definitely the champion of the world in terms of complexity. Jokes aside, one of the main challenges we think we're going to face, not only in Canada but globally, is the big data stuff. Because, and let's put aside the compliance with information protection of personal information laws. Just the ideas of using big data, for example, to spot in your clientele and insurance companies. If, for example, you have an insurance company who do P&C and life, and you noticed in your P&C that a male of 25 years old just changed its convertible car to a family van, and that triggers a flag to maybe this person is going to have child, and maybe it's time for a life insurance agent to contact him and revisit, its needs. That's, to me, philosophically speaking, is using big data for trying to give good advice to consumers, and it's maybe a good use of big data. But on the contrary, if the IT system is built to spot, let's say, life insurance policies whose profits are based on lapse, and identify those who are, in the zone where they should lapse, so the company makes big profits, that's not a good use of big data. That company is about to live its Volkswagen moment. So in the coming, I guess, 5 or 10 years, the potential of big data and crossing of data that insurers will gather and have may give rise to good outcomes in terms of conduct of business and fair treatment of consumers, but also could be the cause of a big problem as well. So we will, in Canada, and we'll speak for AMF here, put a close eye on those issues.
I think I would like to agree with Birny that the market conduct supervision is just as important as the prudential side of the supervision. If we get the consumers satisfied and happy, that will just boost up their appetite and demand for more insurance. The mobile phone is a great channel for a country like Ghana. If we get the consumers to be happy with what they are getting real value from the services they get from this, I think that we'll be on our way to accomplishing our objective of enhancing access to the low income and the informal sector.
Thank you. Maybe just to comment on the response by Birny on financial education. I agree very much with what you said. I think this is important enough to stress that. Financial education is very important. It's not a panacea on its own. It's not the solution, but it's coming together with appropriate disclosures, with professional advice. It is part of the solution to empower consumers. I think this is a statement which is really important because at European level, we do have consumer organizations active in the field of financial services and insurance, and they've been questioning very, very harshly the relevance and the effectiveness of financial education recently. And for me, these kind of messages was to be interpreted a bit like keep people in their ignorance, which is definitely not the solution. There is actually also a role for supervisory authorities, together with regulators, consumer organization, with also the industry, in raising financial literacy and financial education. Now, in terms of my conclusion, the key takeaways and the challenges that I see ahead is that consumer centricity is not only for the industry, it's also for the regulators and the supervisors. It's really important that the consumers' interests are being kept by regulators and supervisors when developing their regulatory and supervisory framework, to make sure that they work on providing the best outcome for consumers. This is absolutely key, and I would like you to keep that in mind ahead of the review of the ICPs 18 and 19, because this is all going to be about consumers' interest and consumer focus and conduct of business supervision. Thank you very much.
So I will agree with my colleagues on the panel. Thanks.
So it's now time to break for coffee. I would like to thank you for your attention and your participation.
So thank you very much. Thank you very much for excellent panel, particularly Olivier, Patrick, Michael, William, and Birny. Excellent. One takeaway here is Birny mentioned and stressed very much our balance is correct, prudential and consumer protection, or more fundamentally, we allocate, as a regulator association, allocate sufficient time for consumer protection issue. And like William stressed very much, too much data, no sort of focus of education issue. And Michael and also Patrick stressed that to now new way of communication like mobile technology or big data, we have to watch carefully and we have to protect our policy holders. Just one announcement or publicity. We are working on this mobile issue, particularly in the context of financial inclusion, in the financial inclusion group. And the market conduct group, your group, is now considering of this new technology, how it would impact on our regulation and supervision. So definitely we take care of, and naturally, of course, amount of, how do we communicate and how to educate or to educate of consumers and so on is a very important issue. So thank you very much, excellent panel. So now we deserve some break. So we will break here until 11 o'clock. So please come back at 11 and we kick off this distinguished fellow panel. Thanks.